We think the economy's tough in Australia. Australians just have so much debt.
Yeah.
So much debt. We're staring down the barrel of a depression. We want different results to other funds. If you want different results, you should be doing different things. We didn't buy into things like NVIDIA, which was an obvious way to play AI. What's attractive about macro investing is you can make money in different cycles. I think it really is a stock picker's market now, but we don't think it's a time to just buy the dip on the past winners of the 10 years.
Yeah.
Hero or sidekick?
Welcome to the Sidekick podcast, where we uncover the hidden superpowers that drive some of the biggest and fastest growing companies and successful names in the business world. I'm Bryce, and I'm joined by my regular co-host Ren, and we are your trusty sidekicks. Ren, how you going?
I'm good, Bryce. Excited for this one. We are joined by Chris Judd. Chris, welcome to Sidekick.
Gents, thanks very much. Well, not having me back on this show, but having me back in the studio. It's good to sit down and have a chat again.
Always fun. Now, Chris is the founder of Cerutty Macro Fund and is a former AFL champion and dual Brownlow medalist. And today we're going to be covering off macro investing and Chris's superpowers when it comes to his own investing. So, Chris, we want to start at the macro investing level. For those unfamiliar, what is the macro style of investing?
Yeah, so macro investing is I guess a style of investing where you're looking for macro themes, which are themes that are long-term and secular in nature. And what that sort of means is themes that can last multiple business cycles. Traditionally, a macro investor will invest in things like currencies, forex, commodities, things like that. We only invest in equities and long-only equities. But for us, our idea generation very much comes from those macro themes.
And maybe just to illustrate it, do you want to give us an idea of a theme and how that sort of translates?
Yeah, absolutely. So, I mean, a theme for us could be something like the electrification of everything. You look now, cars, a lot of them are now electrified. Billboards are electrified. The photos you used to put in your photo album now go on a phone, which requires electricity. Even money in the form of Bitcoin is now being electrified. So this is a very long-term secular trend in nature. We've gone from the most important commodity being oil, or still very much an important commodity, but we think more and more electricity is becoming the most important thing in an economy. And we've all would have read about data center capex through AI and what an enormous long-term theme that is. So we didn't buy into things like NVIDIA, which was an obvious way to play AI. We thought it was fully priced, and we acknowledged that it's just the most brilliant company, but we really couldn't get comfortable with the sort of margins they had, and extrapolating a 90% margin long-term on a company where your four biggest customers are exploring ways to make their own chips. We felt that was unsustainable. But we really like that theme nonetheless. So we expressed that theme by investing in Southern Cross Electrical, which is a large electrical engineering group in Australia that does a lot of the data centre work, but does a lot of electrical work full stop for some blue chip clients throughout the country. So it's one example of a theme which a lot of people were on, but perhaps we played it slightly differently just because we couldn't get comfortable with some of the valuations that those high-flying stocks received.
Why do you think this top-down approach makes sense as opposed to, I guess, other experts who come on and talk about the bottom-up approach?
Well, for a number of reasons. So the first is that most Aussie funds are very much bottom-up focused.
Yep. And
we want different results to other funds. And if you want different results, you should be doing different things. Secondly, we have a very heavy bottom-up focus, but we've got a really small team. So by having that macro lens, or attaching that macro lens to our investments, it really enables us to narrow down which stocks to do bottom-up work on. And when you're a team of two, essentially, that are doing the stock picking, that's really important. So we don't feel like we have to be across every stock in the All Ordinaries. And whilst we don't have much exposure overseas, we do have the capacity to invest overseas as well. So it really narrows down the number of stocks we've got to look at. And we don't get annoyed if we miss a stock that 5x'd if it's in a sector or a theme that we're not really interested in. What we do get annoyed is if we miss, particularly an Aussie-based stock in a theme we really like that rips where we should have been on top of it. So it really helps in narrowing down our focus and makes it more efficient as to where we allocate resources. And thirdly, it just means we end up with a list of stocks that have tailwinds. which is really important as well, because when you've got a tailwind, you just get more wiggle room for errors than you do when you've got, regulatory or top-down challenges.
So for people who are interested in this style of investing, like what makes a good macro investor? This show's all about uncovering those superpowers that power great investors and great performers. So what do you think of all the macro investors you've studied, and as you become a great macro investor yourself, like what are those important skills?
Probably the two reasons I was attracted to it is because it's a way to explain how the world works. And, it's essentially the story of what's going on in our world through finance, which attracted me. But the best macro investors, people like Stanley Druckenmiller, Paul Tudor-Jones, they generally have an ability to change their mind quickly, which is important. But also what's attractive about macro investing is you can make money in different cycles. So if you're a value investor, there's nothing wrong with value investing as a discipline, but there are just times when you might have really loose monetary policy, where on a relative basis, value investors underperform and growth investors absolutely shoot the lights out. Likewise, when liquidity is tight, those growth investors really, really suffer on a relative basis. And right now, liquidity is not too bad, but there's just so much uncertainty that growth investors are finding it really hard to perform. So we like the flexibility that macro investing gives you, and maybe less beholden to the cycles, and it feels like you're more in control of your own destiny than perhaps if you identify as a certain style of investing, which is going to come in and out of vogue.
How do you then, once you've, identified the theme, balance value and growth below that?
Yeah, so liquidity is a big part of that.
Right.
So liquidity for us is what's going with central bank liquidity, not sort of liquidity as in how many shares are being traded in the screen. So when liquidity is loose, think things like money supply. We have a bias towards growth stocks that are promising to do something in the future. But when liquidity is tight or uncertainty is high, investors want companies that are making money today, and that's value companies. So we've probably got a bit of a bent towards value right now, because a promise in the future doesn't mean as much when you've got a president that's tweeting, all sorts of stuff day to day. So we recognise that. We're probably carrying a little bit of higher cash levels, and we've got a bit of a value bent. And then we'll just wait and see. We ultimately think that all the improvements the US is trying to make around their deficits through DOGE and these sorts of initiatives aren't going to work if tax receipts fall off a cliff because capital gains taxes aren't being achieved and paid. And that's the real arm wrestle. We don't think, even if they get $500 billion in savings through DOGE, if the stock market's down 20%, we think tax receipts going to drop more than those savings. So that's the arm wrestle. I think the main priority for the US now is to term out a chunk of their debt at a lower level. And Scott Bessent and President Trump have spoken about the 10-year yield being a main focus and getting that yield lower. And what would make sense to us is, with all the uncertainty that's being created, if they can create a bit of a growth scare, push down that 10-year yield, term out their debt, and then look to get the economy and markets ripping by midterms, which is November 26. So we work sort of backwards from that. That would make sense to us. Otherwise, there's just random tweets around 25% tariffs, 0 tariffs, 50% tariffs. It doesn't make a lot of sense, but it does if you're viewing it through the lens of potentially how can we get that 10-year yield down, because the US government has $9 trillion worth of debt they've got to term out in the next 12 months. So that is a long-term saving they can get if they can do that at a much lower rate than here.
Wow.
So we want to turn to the state of the market. So let's turn there, but stay in the US. There's a lot of tweets, a lot of uncertainty, and a lot of volatility as a result. Like, where are you watching for signal amongst all this noise? Like, what do you think are the most important things to watch, people to watch, or trends to watch?
Well, really, Scott Bessent, the Treasury Secretary in the US, and obviously the President Trump. And I feel they're sort of telling you loud and clear they don't care about the stock market right now. They care about the 10-year yield. And that's understandably so, because they're spending north of $1 trillion a year on interest as is. So that's a pretty big line item.
It's like what, fourth biggest line item in their budget or something like that?
It's crazy. More than defence now, which has always been a mainstay of when great dynasties fall. Once their interest expense is greater than their defence expense.
Yeah, right,
Interesting.
Okay.
So
pun intended.
this appears to be something they want to get on top of.
Yeah.
So that's really who we're looking to for guidance, and we feel they couldn't be clearer that they don't care about stocks currently. I mean, Besant said that investors have had a really good run, and they're more interested in, or they frame it as the working class, and the 10-year as being part of that. So that's the main focus. But that doesn't mean there's not opportunities. But I really do, and you're talking your own book as an active manager at some level, but I think it really is a stock picker's market now. Mm-hmm. When you have 0% interest rates, and liquidity flooding in, you just had to be in the markets to make money, and the more risk you took on, the more money you made. I don't think that's the world we're in now. And it's quite exciting for someone who maybe doesn't have as many grey hairs. Well, there's no hair at all, is there? But as some in the market, because we just come at it through first principles. We don't have a view this is how markets have to work, because the reality is certainly no one's invested in a world where the US has heavy tariffs on other countries. Mm-hmm. You're going back to the late 19th century for that. Mm-hmm. So there's a lot of new things happening, and we think it's an exciting time to be an active investor.
How are you watching the emerging trade war? What are your thoughts around that?
Yeah, we think it's really interesting, and I guess if we move more to not just trade full stop, but manufacturing capacity, and if you look at the West, we think the war between Russia and Ukraine was really a proxy war between the West and Russia and China, and the West were unable to win that war because they couldn't compete with China and Russia's manufacturing capacity. Now, that's been framed as a priority by Besant and Trump as increasing their manufacturing capacity to assist with the working class who've been hollowed out in America once China entered the World Trade Organization. But we're also seeing Germany commit to significant fiscal spending, trying to increase their manufacturing base. And, we think that manufacturing capacity is both important for employment, but more and more has become a national security issue for both Europe and the US. And Trump's been really clear that he doesn't want to continue to have an enormous trade deficit with China. So it's important for a number of reasons. And we think we're at the early innings of that theme. One of the things we take note of is that, one of Trump's other policy items is to reduce the amount of illegal immigration coming in from Mexico. So, how do you build out a huge manufacturing capacity if a lot of your low-cost labour is unavailable? And we think the answer to that is, the manufacturing of tomorrow isn't going to be your grandpa's manufacturing. It's going to be very automated, a heavy use of robotics and new age technology. And there's some of the themes that we think are really interesting to play at the minute. And we think they're at the early stages. You've seen what's happened to European defence stocks. They've just gone absolutely berserk. But we think sort of the next level of that is broad-based manufacturing capacity. And we think we're in the early innings of that.
Wow.
Holding on manufacturing, when we spoke to you, I think last year, but before the election, you mentioned how J.D. Vance in particular was interested in the US dollar. And thought that the dollar should be devalued to support America's exports. Now that J.D. Vance and Trump are in power, how are you seeing what they're doing around the dollar, and how are you seeing that going forward?
We think they'll find a way to make it happen. So I've flip-flopped a bit on the US dollar. We thought initially leading into the election, the US dollar was going to roll over. And then we just saw how much excitement there is from the business community when Trump got elected, and the prospect of deregulation, and we just saw a huge flood of capital storming towards the US, and we found it hard to see how that was going to soften the US dollar. But we now just think there will be some policy implemented to weaken the US dollar because, again, they can't boost that manufacturing capacity if they've got a really strong US dollar, because it's going to be hard for anyone to buy those products. It's going to be non-competitive. And we've already seen some moves take place. There's been an executive order making it harder for countries like China to own US treasuries and US stocks. And so the reason why the trade imbalance between China hasn't self-corrected is because China's currency isn't floated. And China has helped prop up the US currency, first by storing their surpluses in US treasuries and then by storing their surpluses in Mag 7. And that's really starting to unwind. And you can see that capital flood back to Chinese tech stocks, which have absolutely ripped. at the same time as the US tech stocks have taken a pretty significant plunge already. So, we think, I mean, the US dollar is such a dominant force around the world for trade still, but we are starting to see some signs of some softening. And even if you look at oil in the last year, I think 24% of that was traded outside of USD, which is a huge number, which is probably underappreciated. So we think one way or another, the powers that be in the US will find a way to get their dollar down because they sort of have to.
Good for travel. Outside of the US, Chris, what are you keeping an eye on? What are the big macro themes that you think are emerging and important to keep track of?
Yeah, so I mean, things like aging demographics is a pretty simple one and maybe a tiny bit boring, but as people age, they spend more on healthcare. And demographics are a really easy long-term trend to predict. I think even at a it's a bit esoteric, but have you read anything about sort of the kill switch in US defense equipment?
No.
So Europe have been talking a little bit about this, but if you buy a fighter jet off the US, even once you own it, the US still has an ability to infiltrate the software in that jet and decide where you can and can't shoot missiles. Yeah, so there's been big outrage around this. So you spend billions of dollars on this US equipment, but they can still geofence where you can and can't use it. So if you use this as a metaphor, right, like there was a kill switch in FX reserves when Russia invaded Ukraine. The US effectively kill switched their FX reserves, right, which was significant. You think about what would China's kill switch be? It'd probably be in rare earths and antimony, things like this. And then you might start to think which things don't have kill switches in them. And gold being the glaringly obvious one. If you've got gold and it's stored in your country, there's no kill switch available for that. But that broad-based idea of things being, countries being more self-sufficient, it goes a little bit hand in glove with that manufacturing capacity. But even things like oil refining in Australia, Viva and Ampol don't cover anywhere near our oil refining needs. I think it might be 10% of what we need. I think things like that are going to become more and more important as we move very much from a globalized world to very much a multipolar world. Can you grow enough food? Can you produce your own water? These sorts of things which people haven't really thought about because they've had a sort of a just-in-time mentality instead of a just-in-case mentality. But we think that era is coming to an end. It doesn't mean globalization's over. Just the level of globalization we've enjoyed, I think, is going to be reduced.
It's crazy that we're talking about this because I remember even learning about when globalization was becoming a thing in economics in high school. Yeah. It was only, I'd say more than a decade ago, but still, it's just crazy how this just flips and the world changes. Yeah. Anyway,
that's what creates opportunity.
Yeah, it's wild.
So I think one of the big changes in our investing lifetime is, for the first time, Europe is worth talking about. It's even the UK, the most boring of markets, it seems, in the last decade, has done all right. Do you see this as a longer term trend with some of these, the fracturing of the global order, I guess, or is this more just of a short term anti-Trump move and it might roll back?
We view it as a longer-term trend. We don't have much exposure to actual European stocks, but broadly speaking, European stocks and emerging markets, we think it's a long-term trend purely because the concentration of capital in those US stocks and the Mag 7 in particular was just so significant. And that's not going to unwind over 1 or 2 months. If you're talking about Aussie super funds or overseas pension funds, they just move very slowly. They've got investment committees and mandates, and for them to change tact, that's something that's going to take 6 to 12 to 18 months before it gets implemented. So, we think it's likely that structural shift is long-term in nature. It doesn't mean the US is uninvestable by any stretch. I just think it means you're going to have to be more discerning, and you may not get the currency kicker that you've had with US stocks as an Australian, where the stock rips and the currency gives you another little cherry on top.
Yeah, interesting.
So I think final point in our trip around the globe is back home in Australia. So how are you seeing Australia, I guess, manage some of these big themes that you're talking about, and then just is there anything like idiosyncratic about Australia that we should talk about?
Yeah, so I mean, even the cost of living crisis in Australia, we think is really significant. We've got some stocks that have exposure to that. We don't have a lot of discretionary retail exposure in Australia because, broadly speaking, we think the economy is tough in Australia, albeit improving slightly. So we had 7 quarters of negative per capita GDP growth in Australia. We just had a positive quarter.
Yeah,
Just.
And just. That's right.
And we were screaming from the
That's
rooftops.
right. And I mean, just to remind people, and people know, but 2 negative quarters of GDP growth is a recession. 8 negative quarters is a depression.
Yeah.
So without any immigration population growth, we were staring down the barrel of a depression. You know, it's really significant. But if you looked at some of the data points that politicians will point to, you know, unemployment's at 4.1%. The issue with that is if you work more than 1 hour, you're classed as employed. So, I mean, with the gig economy, I mean, most people are able to get a couple hours work on Uber if they want. So unemployment's 4.1. I think underemployment's 6%.
Yeah.
So I think a lot of the numbers that we've hung on to, I mean, even GDP per se, if you've got migration going through the roof, it's just not a great indicator of how the economy is actually travelling. And if you look at immigration, the pressure that eases is on wages, which most people want to go up. And the pressure, but the thing it increases is things like price of services like electricity or food or the things
rental availability,
a shelter. That's
Yeah,
right. So
yeah.
the things people want to go down, it rips them. The only thing people want to go up, the average person, is their wages, and it softens them. So we sort of live on a bit of a make believe world with a lot of these data points. But yeah, we think cost of living crisis is a big deal. We saw the Reject Shop get a takeover offer last week at 110% premium,
Crazy.
which we think potentially speaks to them being a company where their addressable market is increasing because more and more people need to shop at those types of offerings than have done so in the past. We've got a shareholding in cash converters we've spoken about, which is sort of a similar thematic. It's not a sexy business at all, but a lot of people just don't have access to bank credit and need the credit provided by cash converters, and it's also a way for people to buy lower cost goods. So yeah, we think the economy is soft, but we don't think people should get confused with that means asset prices are going to be soft because they're two different things. Asset prices aren't the economy. We've got an interest rate cutting cycle now. We think there are some really good opportunities, but we don't think it's a time to just buy the dip on the past winners of the 10 years.
Yeah.
The last 10 years, people have spoken ad nauseum about the bubble in Mag 7, and I'm not even sure if that's accurate. It was a bubble, but they got really inflated and they were great places to park capital. It's also a real bubble in quality, we think. You know, overseas, things like Costco, even locally, things like Life 360 or Xero, Pro Medicus, these are the most wonderful companies. But we just struggle to buy things on 100 earnings multiple. And whilst the Mag 7's rolled over, we think we're starting to see a rollover in some of those quality names. It doesn't mean they're going to stop being quality businesses, but it may be a time for people to do a bit of work and work out what the winners of tomorrow are going to be. And even the types of businesses, like for such a long time, people wanted asset light businesses. You would have heard, you know, platform stock, asset light. We think now more and more investors are looking at the assets on a balance sheet as an important part of the investment and not just return on equity and these sorts of metrics, which is maybe a bit of a more old-fashioned way to invest than we've seen in the last, 10 years or so.
Back to Benjamin Graham's net.
It's a little bit of it.
Yeah,
There's a little bit of it. And it does, you know, when you do see a company with a heap of cash on their balance sheet and a heap of assets, it does just give you a bit of security, like how much lower can this thing go if you don't get it right? And we're seeing that in some of our positions currently.
Just before we take a quick break, what are your views on rates in Australia? Where do you think that's going to play out for the rest of the year?
Well, we don't have super strong views. I think consensus is for another 2 rate cuts this year. We think that's about the mark. Australians just have so much debt.
Yeah.
So much debt. So our government doesn't. Like, our government debt's 60% debt to GDP. You know, US, you're looking at, I think, 127. So at a government level, it's fine. But the debt at a private level is through the roof when you compare to other countries. So the issue with that is if they cut rates and property prices rip, it's just going to exacerbate the problem. So I can see, but then you can see just people squealing at their cost of living challenges they've got. Yeah. And, you know, businesses, particularly hospitality businesses in Victoria, things like this are just really struggling to make ends meet. So I wonder if there's a way for them to cut rates, but put in sort of tweaks to, I don't know, APRA or financial regulations where maybe it's harder for people to get loans to buy houses. We've seen it making harder for overseas people to buy houses. If they can get some interest rate relief whilst some policy measures to stop house prices ripping, I think that'd be nirvana. And I think overseas, you know, prohibiting overseas investment in fixed asset properties in Australia will help that. But again, she's got strong migration and limited supply coming on board. So I think that's the challenge they're grappling with. We've got a couple of rates in. We spend more time thinking about US rates than Australia for how we invest. And even in the US, we think the rate cuts are less important as when that debt's termed out. And that debt, you know, the duration of the US debt has come down a lot. So we think that's something really important that the US will be trying to do.
Well, Chris, we're going to take a quick break here and then on the other side talk about how these themes that we've touched on translate to your portfolio.
Great.
This series wouldn't be possible without the support from Superhero.
Superhero Super is a low-fee, award-winning super fund with a wide range of investment options and the flex to invest directly into ASX-listed shares, ETFs, and more. Superhero Super is primed for performance. Superhero also won the 2024 Excellent Rates and Fees and Best for Direct Investment Awards by We Money Superannuation.
Now remember, Superhero does not provide financial advice, so consider whether their product is right for you. Read their PDS and TMD and download the Superhero app at superhero.com.au. Interests in Superhero Super are issued by Diversa Trustees Limited as trustee of One Super. Superhero Super is a subplan of One Super. Welcome back to Sidekick. We're here with Chris Judd, founder of Cerutty Macro Fund. We've just gone through what macro investing is and a bit of a round the world when it comes to state of the markets. But Chris, this is the fun part, actually understanding how it translates to a portfolio. So having digested all of that, how does this all translate? How do you take all of that information and package them up into the major themes and then actually express them through your holdings?
Big question.
Yeah.
How long have we got? Cancel at 3 o'clock. Look, I guess that's the challenge. One thing we do, we have our themes and we have stocks within those themes that we like. But what we really focus on is making sure our favourite stock is our biggest holding. And we think that's a trap that can just get away from you. You might really like a stock, particularly at this valuation, and then you look in your portfolio and it's your 20th biggest holding. And it might do really well, but you don't make as much from it as you should. We spend a lot of energy on which themes we like, a heap of energy then on which individual stocks to express those views. But even once we've got our portfolio set, there's a lot of internal competition to make sure that, particularly when we look at our 6 biggest holdings, they're our 6 favourite stocks at these valuations. And that requires, you know, constant tweaking and work. In terms of some of the themes and how we're expressing them, caveat, not financial advice, and we reserve the right to change our mind really quickly. So don't come sooking to me on Twitter if you buy these and they don't work out. Put on your big boy pants or your big girl pants and own your own decisions. But our biggest holding is Visan, which we love. We've spoken about it a bit. It's a diversified water services business. It goes back to that, you know, security of water as a resource is really important. A large chunk of their business is dewatering iron ore deposits in the Pilbara, most of which are under the water table, which is a long-term secular trend. But they've also got a division, Visan Asset Management, where we think they're going to be able to, you don't mine water, but you produce water from deposits in the Pilbara and create offtakes for that water, which many businesses in that region are crying out for. So the Pilbara is funny where there's 2 Sydney harbours worth of water in the Pilbara.
Wow.
But then there's huge areas with no water.
Wow.
So to be able to I guess bridge that gap with the areas that don't have any with some of the areas that do, and the economic value that can unlock for that whole region, we think is really significant. And we don't think that division of the business, which is relatively new, is being attributed much value in the market. So we think that's a really interesting company. We've been there for a while. We love management. James Clement is an ex-AFL player. We don't just invest in companies run by AFL players because that would be a skinny pool. But he's a great operator. We love that. We've spoken about Southern Cross Electrical.
You mentioned Cash Converter, so I'm interested in that company because I've seen it advertised a lot on TV recently, and maybe it's just because you've mentioned it, it's kind of come to mind. But I remember when I was a kid, I would used to go there and buy secondhand golf clubs back in the day.
Yeah.
But like, what's the?
It's not really a retail stock, so it's actually a loan business.
Yeah.
And a lot of people think they're sort of doing payday loans and things like that, but they're not. They're highly regulated. If you get a loan for $400 and you can't pay it back, the most you'll ever owe is $800. It's not like people have these views of, the payday lenders where you start with a $400 loan and in 6 months' time you owe $25,000. That's not them, but plenty in the market still have a view of that's what it is. Got a 45% shareholder Easy Corp out of the US, but it's just one of those businesses. They've got a really clear growth strategy because they're buying up franchises and rolling them into their own business. So they've got a big pool of franchises they can buy both in the UK and Australia. And these are businesses they know really well because they're intimately involved with the business day to day. So the DD risk on Cash Converters executing an acquisition versus another company that's buying something they've got limited experience with, we think is greatly different. And they're just wildly cheap. They've got plenty of money in the bank. They've got some strong growth. They pay a 10% divvy? It's not quite that much now.
And what's the macro theme that kind of drove that?
Cost of living crisis. So, and the Aussie banks, they just want to do mortgages. So there's a whole heap of people that just don't have access to finance. The other thing I quite like about it is, if anything, ESG investing was really hot. If anything, I'd be more interested to trade in anti-ESG stocks. This is a stock that would have been on the naughty list because the type of people that get their loans, even though these people have no other options, and it's really important they have some access to finance. But if you look at, whether it's gambling stocks or, coal stocks, oil stocks, a lot of these, not all, a lot of these are really undervalued because super funds in Australia can't buy them, and flows have such a big role in valuations. And we think a lot of that ESG trade or the obsession that people have around that is going to be unwound.
Yeah.
And you might get a re-rate, not just on the business, but on the multiple people are prepared to pay for it.
Yeah, we're certainly sort of seeing a big difference in people's enthusiasm for ESG now compared to 4 or 5 years ago.
And I think people, they got told that solar was the cheapest electricity you could have. And they're looking at their power bill since it got introduced, and it's not really stacking up. I think there's more and more questions being asked around things that the nuance is missed. Like when they model solar or wind, they never add redundancy cost to that price of that electricity. And there's no grid in the world that just runs on solar or wind. You've always got gas redundancy or coal-fired redundancy, which completely changes the dynamics. So I think there's a lot of these sort of platitudes that get promised by policymakers that are just sort of half-truths, and in the cruel light of day, they don't stand up.
So you've mentioned 3 stocks there: Cash Converters, which relates to cost of living; Visan, which is around that water theme; and then Southern Cross Electrical, which is that electrification of everything theme. I'm interested in portfolio construction and how you approach it. Is it sort of like a certain number of stocks for each theme? And then is there a certain number of themes you want to have at any one time in the portfolio?
There's no hard and fast rule. So we've got, I think as of today, 31 positions, but we've got 4 gold stocks. So that to us is almost one position. We're not mining investors. We'll invest in mining stocks, but technically we don't have an edge in mining, and we're conscious of that. So if there's a view we want to express in mining, our preference would be to buy it through a basket of stocks. So we don't get the theme right, but get the metallurgy wrong, and that just drives you crazy.
Yeah.
So, we've done the same thing with uranium, where we've got multiple uranium stocks, but that's really just one trade for us.
Yeah.
And, generally we plan on holding 15 to 40 stocks. We're just conscious of not having lookalike stocks. So, Southern Cross Electrical, it's actually got pretty strong growth. But there are other businesses where their financial metrics might look similar in terms of the type of value play it is, even if it's not in that same industry. And it's, you can still have really strong correlations, even if they're seemingly different industries, if just the types of financial metrics are very similar. So we're conscious of that as well. Right now, in terms of portfolio construction, if you were talking about a footy field, I might have used this metaphor. It's a bit of a naff metaphor, but I'll keep using it. If you've got your forwards, your midfielders, your defenders, and your cash would be interchange players. We're skewed more towards midfielders and defenders. So a really low PE stock for us, or gold, is a defender for us, right? A midfielder might be a reasonably valued, somewhat quality name, and your high-flying, high-growth name would be your attacker. We don't have many attackers. We've got some uranium stocks, which trades like an attacker, and that would be in that basket. And we've got a couple of other ones, but we're skewed towards midfielders, defenders, and we've got a higher interchange or cash allocation than we normally have at the minute.
Nice. I'm imagining your office with a big board of football field.
I've used this before. I've used this before.
You're off.
I've used this. I used a cricket metaphor at a presentation with some well-known cricketers there, and I had a mate there just shaking heads going, "That's the most naff thing I've ever heard." Which is,
they're probably thinking stick to your sport.
Yeah.
Well, Chris, this podcast is all about finding the superpowers that drive success, and you've obviously had a lot of success in football and now in funds management. What do you think are the personality traits for yourself that have kind of allowed you to have these levels of success?
I think the most important thing is getting to know yourself better and better, and investing, and football, know which game you're playing. So lots of people invest in the stock market, but they're all playing a different game. I mean, you with your 23% a month returns, that's a different game to
Very
what we're
different.
playing.
You
Then you've got
defenders in that.
you've got algo traders. Well, they're playing a different game to us. You have, day trade. It's all a different game. You need to know which game you're playing, and the game needs to be suited to what your personality is. I guess one of the things that I saw that was powerful in football was seeing things that are efficacious for performance. And if those things are uncomfortable, that's where the opportunity is. So the analogy to investing would be volatility. We think being able to withstand a level of volatility is effective for long-term investment performance. But it's uncomfortable. And as a result, particularly a lot of allocators investing money on other people's behalf will try and smooth out volatility, which in the short term may make it easy to attract flows, but we think in the long term there's a cost performance for that. So that's sort of one example. But generally, if there are things that are uncomfortable doing that help performance, whether that's in sport or business, that's something that you should explore and be attracted to, because that's often where the opportunities lie.
Yeah, I love that.
On that point, you've gone from running your own money to running a fund, and when you run your own money, you can withstand as much volatility as you like, because you've only got to answer to yourself. I guess your family. But now you're managing. Now you're answering to others, and you're reporting monthly or quarterly. How have you found that transition?
I've loved it, and it is different. But that's sort of what I was looking for. Like, private investing's great, and there's opportunities there that institutional investors don't have, and there are some edges to being super small and nimble, but probably the pressure and accountability just isn't the same, and that's probably what I was craving, and what I've now got. And the most enjoyment I got as an investor was when you could ring up someone else on the investment and say, how good was that? Or you can ring them up and say, how crap was that when it doesn't work out? Like, it's nice being able to share that with other people. So we've got a great small team. We've got a lady in admin that helps, and I've got a young analyst, Tom, who does a great job. But yeah, it really does mirror that sporting vibe, because every day there's a scoreboard. We've either won or we've lost. And at the end of the month, we've got to tell our investors how we went on the scoreboard, and there's no, these are all tradable assets. It's highly accountable. We can't, it's not an unlisted property. We can say, oh, look, it went up 4% this quarter. What a result. So I like that component. It breeds accountability, and you do just push a bit harder when it's not just your own capital on the line. And I think I mentioned to you when I first came on, I was just getting a bit of a chip on my shoulder, and people say, what are you doing? and I'd say I'm a private investor, and they'd look at you like you were just a complete bullshitter. Like, sort of look like they wanted to give your head a little rub and say, "Oh, that's cute," you're unemployed.
Yeah,
And
you're unemployed.
I was like that guy, like surfing around the corner from Bell, saying, I could be in the comps if I wanted to, but and so it's good to just be in there, and our results are public, and I've liked having those doubters too, because I remember that feeling before getting drafted. I had a couple of shoulder recos, and I remember that feeling of people saying, I don't think you'll be able to play AFL. And then, you have some success and those doubters go, it's been nice to be back starting out at a new venture. And you sort of hear secondhand from people saying how things will pan out. So, it's been an enjoyable ride so far, albeit early days.
Yes, love it. Well, Chris, it's always a pleasure chatting to you. You always leave us with a lot to think about. If anyone wants to find out more information about your fund or even the monthly reports that you send out, where can they go? Yeah,
they can go to ceruttymacrofund.com.au. All our historical monthly reports are up there, so they can have a sticky beak and they can jump on our mailing list.
Love it. Well, thank you so much. It's always, as I said, a great pleasure chatting with you.
Thanks, guys. Lots of fun.
And if you're interested to learn more about how to grow your wealth like a superhero, head to superhero.com.au/invest.
And subscribe to Sidekick wherever you're listening or watching so you don't miss an episode. That's it from us, your trusty sidekicks. We'll be back uncovering more superpowers next episode.